Hey everyone, welcome back to the Above Board podcast. And today we're talking about your money. I'm your host, John Kennedy. I'm a certified financial planner and I'm co-founder of Candor Path Financial along with Matt Marcoux. And today's episode, I'm going to mess with you a little bit, but we're going to do it in the best possible way. So we're not going to talk about market trends or tax efficiencies and hacks. We're going to talk about something that most financial plans, in my estimation, ignore almost entirely. And it's not your asset allocation, it's your emotional allocation. The reality is that you can have a perfectly diversified portfolio on paper. And for you, that might be like 60% stocks and 30% bonds and 10% cash and still be completely out of balance internally. And whether you know it or not, that imbalance is going to sabotage your finances. Maybe not overnight, but over time it certainly will. So you've probably heard the term asset allocation 1,000 times. You've heard us say it before. It's foundational to the work we do. And it's something that I think in my industry, like it's table stakes. You're not a very good financial advocate for someone if you're not talking about their asset allocation. But emotional allocation is probably more important because asset allocation is predicated on your emotional allocation. Like one won't work well without the other. So what we're talking about is that emotional weight that you assign to different parts of your financial life. And oftentimes you don't even realize that this is happening. So let me give you an example. The high income earner who has way too much cash sitting in a savings account because he grew up in a household where money was always tight. And the idea of not having cash on hand triggers anxiety. So though he makes great money, he's never putting his money to work for him. And that completely disables any and all benefits of compounding interest if it's just sitting in cash only. In fact, there's a great chart that I, from time to time, use in conversation with folks that illustrates how long it takes to get to your first 100K. And so the example is something like if you're saving $7,000 per year at a rate of 7% per year. And again, this is assuming market returns, and this is assumed, but at a rate of 7% per year, it takes 10.2 years to get to that first 100K. The next 100K only takes 6 years. And the next 100K after that only takes 4.25 years. So if nothing changed based on my inputs of adding 7,000 a year at 7%, then what gives? Like why is it so much faster from 100 to 200 and then even faster from 200 to 300K? Well, it's simple. It's the money that you've saved is now making you money. But in this instance of the example that I gave with this high income earner, they never get to experience that because they're not taking those risks or investing in the market, and they're just kind of squirreling it away in cash and losing money against just inflation alone. So allow me to go from one extreme to the next in my examples. Think about the DIY investor who's got half of her portfolio in crypto. Not because it fits her plan at all or her life or anything, but she can't stop comparing herself to her friend who got rich on Ethereum, and now she's hoping to hit pay dirt on this. Another example I want to give, it's the retiree who refuses to sell a stock that is a significant portion, aka too much, of their overall investments because he or she's emotionally anchored to that company. I see this a lot when money is inherited from folks. Like it's not even a capital gains issue that's causing them to hold on to the stock. It's not because they're fearful of a tax bill. It's because like this is the stock that my parents always said to hold on to in good times and in bad, and it would serve me well. And now they can't overcome selling it. And I've run into this with companies like GE or Disney, not saying anything negative about a company like that, but if one company becomes a significant portion of your allocation, that might not make a lot of sense either. So these aren't just investment decisions. You see, these are emotional decisions dressed up as investment strategy. A few years ago, I had a client, let's call him David. So David, great income, high impact, high leadership position at his company. He had a company retirement plan and stock options, health insurance, the whole thing. But every time the market dipped, he wanted to move to cash. And so we tracked it. And he was chasing, that flight to quality, that safety component, and then missing every rebound as a result of doing this. And his fear cost him way more than any recession did. And Michael Scott on our team talks about this a lot, that oftentimes the best days in the market, and so let's say in the stock market in this case, is followed by, or the best days in the market follows the worst days. So to me, this scenario that I outlined with this person, David, is like the absolute worst case scenario. We participate in the down days, And then after not being able to stomach it for a while of that, then we get out and we lock in our losses, and then we miss the good days. And then what ends up happening is you see enough good days start to stack on top of each other. So then you grow a little more comfortable with the idea of equities again. So you get back in only to experience the same emotional cycle all over again. This is where behavioral finance comes in. There's 3 terms that come to mind that I want to talk about. It's loss aversion, anchoring bias, and confirmation bias. So loss aversion tells us that we feel the pain of a loss approximately twice as strongly as the pleasure of a gain. And we're no stranger to this topic on our podcast. In fact, if you go back, I'd encourage you to go back and listen to episode 58 of the Above Board podcast. You'll hear me talk about this very thing. The episode is titled, Losing Hurts More Than Winning Feels Good. And then the second one that I want to talk about is anchoring bias. So this is what keeps us emotionally tied to irrelevant benchmarks, like the price that we bought in at something at, or looking at like the Dow Jones every time the market goes down and say like, oh, look what's happening. The Dow's down 1,000 points today. Meanwhile, that benchmark might be completely irrelevant in comparison to your portfolio. And confirmation bias. This is when we look only for data that supports what we already feel. So often people will do this with their stocks that they own in their portfolio, and fear and greed play a huge part in letting our emotions run wild on us. So what do we do about it? Here's a couple things that I want to bring up that I think help bring your emotional allocation back into balance. The first one is doing a money personality audit. Now, if you were to ask yourself one question today from this episode, I'd like for you to make it this one. When it comes to money, what fear or belief has the strongest grip on me, and where did that come from? Because until you can name it, it's going to run the show. And after you name it, you can at least start to rewrite the script a little bit. I dedicated an entire segment to our online course about this very topic. If you'd like to check it out, please do me a favor, head over to www.yourmoneystory.app. It's a free course that talks about money, how to save it, where to put it, breaks down all different kinds of investments. It's really meant to be an expansive course on money. But if you would, do me a favor and go check that out and let me know how you like it. Specifically the component of your money personality, because I think that ties in and is very sensitive to this conversation that we're talking about today. I think the course helps a lot with that. The second one is pairing assets with goals, not feelings. So stick with me here. Don't put your vacation fund in cryptocurrency because it might go to the moon. We want to align our investments with our time horizon. So if you need it in the next year or two, stable assets like maybe CDs or money markets or savings accounts, that's going to be probably your best option. If you don't need it for 15 years, your risk tolerance can increase to more growth-oriented investments because your timeline has increased. The third thing is I really like this one. It's something that my wife and I practice a lot. It's creating friction before large money moves. Now, I've heard some pretty crazy stories about this. I've had a client freeze their credit card in their freezer, in an ice block. That was almost like a break in case of emergency situation, and it forced them to think twice. And I love the idea of that. I love what that represents. It's kind of a cool idea, but it's pretty extreme. But let's just make it harder to react emotionally. We use the 24-hour rule. I'm not shy to sharing this on the show, but before any major decision that will have a financial impact of $500 or greater, we sit on it for 24 hours. That comes with a plethora of benefits. I've heard other people say that they sit on it for a week or a month, but at least put some kind of buffer in there to give yourself some time to think about it. And that's also scalable to the amount. So if it's meaningful to your family for it to be $100 or more, it should be that number. Think about what is going to be that number that it needs to be for your household. I am a huge advocate on creating rules to abide by so that when your emotional brain wants to take over and react to something big, you've already got these rules set in place, like the 24-hour rule, that you can abide by. The last one I want to talk about is revisiting your financial plan often. Because if your emotions are in charge, and sometimes they will be, your plan might need to be revisited or recalibrated. And that's okay. I think, but I do want to acknowledge that everyone listening to this show should be using some type of online platform to access and view a live tracked net worth and a live tracked investment summary totaling everything you own and everything you owe. It's 2025. There's no excuses or reasons why you don't have access to something like this. There's so many paid tools and free tools out there to provide this. The hard truth is it takes work. Even if your portfolio looks perfect on paper, like we opened with, the 60, 30, 10, if it looks perfect on paper for you, you still might find yourself feeling anxious or scattered or at worst, even worse, reactive to things. That is not a numbers problem. That probably means you need to start allocating some time and effort to the emotional side of the equation. Not doing so will honestly cost you more than any recession ever could. And this podcast is, I think it's a great reflection of the work that we do in our daily lives to help others live an enriched and meaningful life. There is almost no topic that's off limits when it comes to this podcast, number one, but also to your finances. Because if you think about it, like every decision you make or every aspect of your life in some way involves finances. That could be big or that could be small, but there's always some type of monetary impact somewhere when it comes to all these different things that we talk about. And so our mission is to be able to help people make those decisions and make them with an informed approach. And we love talking about that here on the Above Board podcast, and we love our listeners even more. We're grateful to be doing this thing 5 years strong and hopeful to keep coming up with more useful insight and honest conversations to share on the Above Board podcast. Until next time, thanks for listening to us. We'll see you next week.